Well, good morning and hello to all the participants as you come into this webinar. Um, Today I'm joined by Nick Street and Nilay Shah to talk more about the tax advantages of owning ASX listed shares. Thank you for joining. In some of our previous presentations, we've had discussions around other areas of investment, and today we chose to talk more about ASX listed shares and the tax consequences. So in the past, we have discussed a couple of key areas of investment. So we've talked about businesses and operating in a business sale environment or business purchase environment, which is one way to create wealth. We've talked about property, property is very popular amongst our client base and out in the community to build wealth. And we thought today it'd be good to talk about shares because there's some unique things in the share space that can possibly make shares a really good investment from a tax perspective. And we'll cover off on a few of these key issues. Nick Street deals with a lot of clients who are share investors and have been successful in that area when it comes to owning shares perhaps outside of superannuation. And Nilay's dealt with a lot of clients who have dealt with share investments within superannuation. So as usual, we'll run for around 30 to 40 minutes. Please feel free to put your questions in the chat or the Q&A box at the bottom of your panel, and we look forward to sharing information with you today. So as we kick off, there's a bit of a summary of what we're going to look forward to talking to you about today. The first concept there is we've spoken about negative gearing previously in the context of the property market and the idea of going and borrowing a sum of money, buying an asset in property, and then having a tax loss. So we're going to explore that concept today in terms of shares and how you can do something similar there. We're also going to talk about the positively geared strategy and how you can also get positive income when it comes to shares, followed by what it looks like to own shares in a self-managed super fund. There's some unique opportunities there when it comes to self-managed super funds. For example, a super fund can accept shares transferred from a member that are ASX listed. We're going to talk a little bit about capital gains tax when it comes to shareholdings, and finally some tax planning opportunities, particularly before year end. So in terms of the shares themselves, I guess one of the questions that people often have when they're investing is what makes this particular asset class unique to taxation, and how is it unique in terms of investing? Because the tax law does apply differently to different classes of investments. So when it comes to share investments have this unique thing called franking credits and a franking system. And many of you may have heard of this, and you may see this in the documentation you get when you receive dividends paid from particularly ASX listed companies. And interestingly, this franking system applies to private companies as well. So if anyone has a private company, you might be familiar with franking credits. So up on the screen, there's just a little illustration of how franking credits work. And it's really important that I guess we communicate to everyone participating today the power of this franking credit, what it means. So there we have an example of, say, let's say there's a Commonwealth Bank. It's probably from our research within our client base, it's the most commonly owned share. So we use it throughout today's presentation. So Commonwealth Bank, let's say they make a profit of $100. We know they make a lot more, but let's presume $100 to keep it simple. They will pay tax of $30 on that profit, which leaves them with a net amount of $70 after tax. So the CBA receives this $100, pays $30 to the ATO, has $70 left over. If the CBA decided to declare what's called a fully franked dividend for the full amount of their profit, they would declare a fully franked dividend of $70, and then that $30 that they paid, they would pass to the shareholder as a tax credit. So as a shareholder, you're now assessable on $100 being the $70 of cash you've received plus the $30 credit we can see there. When you're making your tax return at the end of the year, this tax credit offsets directly the tax you pay on this dividend. So at the bottom part of the screen there, you can see there's an assessment of $100, tax of $30, but a credit of $30. So ultimately, the person in this position would pay no tax on that particular $70, the tax-free dividend. And that's so important because when we look at what it means from an income perspective, because I've referenced this previously in some of our other presentations, building wealth is about combining a growth asset with the income associated with that asset. So it goes up in value, but you also get income. The income is really important to sustain investments. So as you can see there, the $70 dividend actually becomes a $100 return. It's a 42% increase because there's no tax that's payable on this dividend anymore. So essentially, franking credits, in summary, give a shareholder a 42% increase in their return on investment from a cash flow perspective. It's an incredibly generous return or tax benefit that you get. So it's something to bear in mind when you're making investments. I'll throw across to Nick now to talk more about the specifics of certain circumstances. So negatively gearing a share portfolio. So Nick, do you want to run through what that means for people?
Yes, thanks, Nick. So first example that I'm going to look at today is a negatively geared share portfolio. So in this example, we've constructed a $100,000 share portfolio that consists of just one share, which is Cochlear. So to get $100,000 worth of shares, you'd buy 432 shares. And we're assuming that the dividend yield is 0.92%, and it's a fully franked dividend. Now, to finance this share portfolio, we have borrowed $50,000 and we've used $50,000 of our own money. And we're assuming that the interest rate on the borrowed money is 6%, which is the standard rate you'd pay if you went out and obtained a margin loan. We're assuming for this example a tax rate of 34%. So what we've done is we've illustrated two important concepts, the tax position and the cash flow position, and they're different, as you can see. So from a tax position, the dividend you receive of $920 is income. The franking credit, which is attached to dividend but not cash, that is also counted as income. So your total income will be $920 plus $394. And what we call that is grossing up. You might hear that in the media, or an accountant might talk about that. Then you get a $3,000 tax deduction being the interest outlay. And that means that from your $920 dividend, you have made a loss for tax purposes of $1,686. And you can actually claim that loss against your other income. So what that will mean is that your tax will be reduced by $573. You then get to add on the franking credits into your return, and the ATO will effectively pay you the $573 plus the $394. So they'll give you a tax refund of $967.
And so the way this tax refund, Nick, is generated is by essentially it's a reduction of, if you have other income, your other income taxation is reduced by this $967. Or alternatively, if you have no other income, you'd get back a sum of money being the $394 because you have no tax to receive there. So
that's right. And you recall that in the previous federal election, there was a big hoo-ha over whether franking credits would be refundable or not. And in the end, nothing changed, but that's what the Labor Party were threatening, to take that away.
Yeah.
So when you look at the cash flow, your dividend of $920 is something you receive in cash. You have to pay out $3,000 of interest, but then you'll receive a check from the tax man of $967. So effectively, to own your $100,000 share portfolio, it's only cost $1,113 in cash outlay for the year.
Yeah. And in this example, I mean, we've chosen a real listed company, Cochlear. The dividend yield is reasonably low, 0.92%. It's quite a low dividend yield, therefore it gives the negative gearing benefit. We could have chosen any sort of company. to do this. So this is just, I guess, one example of what we've seen there in front of us. So that's negatively geared, and probably similar to what we've spoken about in previous webinars. We've spoken about properties that are negatively geared and they have a negative cash flow. So that cash flow would have to be funded. A question we've got from one of our attendees is, where can you usually borrow money to purchase shares? Where would this normally be sourced from? I guess in relation to that, in our experience, the concept, we've introduced the concept of borrowing for this webinar. It's something that I'd probably firstly say is less common than what it may have been some time ago. It's probably something that we see that people are less likely to do nowadays. The sources of funding, though, however, there are things called margin loans. So they are loans that people will essentially take out and they'll mortgage the value of those shares to borrow against them. There are some particular specifics around that which you need to seek advice on, because they are risky in terms of if the portfolio values can drop, the lender can have all sorts of recourse against you. Alternatively, we see people often drawing off other assets. So it has been quite common in the past to see people maybe own a property, draw equity off those properties, then use that money to borrow to buy into shares, which is a perfectly legitimate purpose. If it's done the right way, that interest can be made tax deductible. So moving along to our next scenario, which is a positively geared share portfolio. So Nick, how would that look?
Okay, so this second example is a little bit different to the first example, where we've chosen the Commonwealth Bank, which, as Nick said, is a favourite share for Australians to own. And we're assuming that 100 shares have been purchased, again, to build a share portfolio valued at $100,000. Now, we're assuming a dividend yield of 3.48%, fully franked, which you recall the previous example was under 1%. So this is a much better yield. And to fund the purchase of the portfolio, we borrowed half of the money and used half of our own money. And again, the interest rate is 6% and the tax rate 34%. And we've illustrated what the tax effect is and what the cash flow effect is. So from a tax perspective, the $3,480 cash dividend that you'll receive is taxable, as is the $1,491 franking credit that's attached to that dividend. Again, you receive a tax deduction for your $3,000 interest expense, and you end up with taxable income from share portfolio of $1,971. So compared to the previous example that was a negative, this time you have positive taxable income from the share portfolio. So tax payable is $670, but then what you get to do is you get to include in your tax return the franking credit, which is quite significant, of $1,491. So you end up with a tax refund of $821. So even though you had to pay $670 as tax, you get a net refund of $821, which would either reduce other taxes that you have to pay or be paid by the ATO back to you as a cash refund.
Nick, in terms of the how the tax system's structured, I always find this sort of example to be one of the more unique ones, in that it's very rare we see circumstances with taxpayers where they actually owe the tax office money. If you look on face value, this is a particular situation where you're earning an income which is subject to tax, but the way the tax law interprets it is that the ATO actually owes you money as a refund. There's not many areas of our tax laws. Like, another area I can think of that might come close to this is research and development expenditure, where people are incentivized and get cash payments from the government for eligible expenditure in terms of creating particular types of assets, software, unique innovation. But this is one where I think, and that's probably quite specific. I think that the R&D space is quite specific for entrepreneurs, whereas this one is a tax break which is eligible for anyone. I think anyone can really buy a Commonwealth Bank share and enjoy the benefits of what the government's offering in this particular instance.
Well, that's right. It's incredibly powerful and incredibly valuable. And during the year, as you collect your cash dividends, the franking credits simply add up and come back to you at the end of the year as part of your tax return.
Yeah.
Often forgotten about, but astute investors will always ask, is the dividend being paid fully franked?
Yeah.
And that's why they want to know that a fully franked dividend is far better than an unfranked dividend.
Yeah.
So the next column is the cash flow. So in this example, you receive $3,480 in cash during the year from dividend payments. You pay out $3,000 in interest, but then you get to bank a tax refund of $821. So what that means is you have a net cash flow of $1,301. So of your $100,000 investment that you've borrowed half, each year you'll receive $1,301 in cash after tax, plus any capital growth that may accrue on the share.
Yeah. Excellent. Thanks, Nick. So we've got here a scenario in terms of the share. So we've got the Commonwealth Bank shares, and we mentioned earlier in our previous slides, so the shares were purchased for $100, so it equals a $100,000 share portfolio. And Nilay, do you want to talk a bit about, in the SMSF context, what happens when we have a share that increases considerably in value? You know, that has its own consequences, but we want to now get this share into a super fund. So I mentioned right at the start that super funds can, interestingly, accept transfers of listed ASX shares from their members.
Yeah, that's correct, Nick. What happens is if you have any shares held outside self-funded super fund, whether it can be under your personal name or any other entity, the super fund, you can transfer those shares into the self-funded super fund if you want to get the benefit over the years due to whether it's a growth or whether it's a revenue point of view, because the self-funded super funds are kind of more tax-effective vehicles. So yes, that's possible to transfer shares into the super fund. In this particular case, what happened is we were just going through the scenario where, for example, the CBA shares value is 100,000 because 100 shares at $100 per share. And we assume that share goes into, just gets double, $200 per share by 2031. So, what happens now in the super fund, there are two particular scenarios. One is the member accounts in accumulation accounts and the member accounts in pension account. So we try to have a different scenarios here so that what's the ultimate next position or tax position in each of the scenarios. So in this particular case, 100,000 is a total gain because if you sell that $200,000 worth of shares, if the members are in accumulation phase, which means what happens is they're entitled to get the 1/3 discount because in the superannuation area, there is a discount is 1/3 if you held the share more than 12 months. So 33,333 is the discount. And so the taxable capital gains would be 66,666. And in super funds, 50% tax is payable. So it's 10,000 is tax payable in a self-funded super fund, which is approximately 10% of the original gain of 100,000.
So this is quite common, Nilay, where let's say somebody, purchases shares and the member might be a 40-year-old and they hold those shares for 10 years. They're at the age of 50 and they decide to sell. They're in that accumulation phase for SMSF purposes.
True. It's very common in our, super funds I manage. I observe that there are various scenarios where, the members hold the shares for more than 10, 15, 20 odd years. When they sell it, the maximum tax they're paying is 10% if they are in accumulation phase. And if they are in pension phase, the results gets even better because if the member is in 100% pension phase, then all of those gains will be tax exempt, which means you're not paying any tax at all. There are clients who, as you mentioned, in their 40s, they buy the share, and when they retire early in 60 or sometimes in 50s, but they retire in 60s and then they sell at that time. So 20 years of the growth in that shares, and they end up paying zero tax. So it's quite substantial tax.
So it is helpful to own these shares within a SMSF environment. I guess the next question then is, how do we actually get the shares into the super fund? Because it's a very common circumstance where people will often, we spoke earlier about negatively geared and positively geared shares, which applies to often people in their personal circumstance. They might buy shares in their own name, but they get to this point and they say, right, I want to build up my super fund. I want to take this share and put it into my super fund. And we've got two options or two ways of doing that.
Yep, definitely. So there are two options. One is you can sell those shares to the self-funded super fund, and super fund can buy those shares on that day's market value. So what actually happens is it's like selling those shares to any other person, but it's in this particular case, you are selling it to super fund.
Yep. So super fund has we'll keep it simple. Super fund's got 100 grand in its bank account, 100,000 in its bank account. A person has $100,000 of CBA shares, and the money just transferred, and the share then goes across. Yep, like any purchase.
Simple as that. Yes, that's right. And then the other situation is they make a contribution, so that they transfer the shares into the super fund on that day's market value. And in that particular case, super fund doesn't have to make any payment as long as that member can make a contribution, so eligible for contributions. So now let's see how it works in both the scenarios, that what is the difference coming in both of these ways. So let's see the first one, which is CBA shares, 100,000 shares held outside self-managed super fund, which means the purchase price was $50 in, let's say, 2012. The value of the shares at that time, 50,000. The current share price is $100, so the total value is 100,000. So if you have to either sell shares to the super fund or you transfer to the super fund, you incur capital gains of $50,000. Outside super fund, 50% discount there. So you have 25,000 discount, and the remaining taxable amount of 25,000, let's consider the tax rate of 34%. You end up paying $8,500 worth of tax outside super fund. Now let's see what is the net tax situation in both of the scenarios. So in the first scenario where you transfer the shares to the super fund, number one, you end up paying $8,500 worth of capital gains outside super fund. But then when you make those $100,000 contribution in super fund, you're able to claim $27,500 worth of deductions in your personal tax return, which would give you a tax saving of $9,350 because 34% of that amount is that. And also in the super fund, you end up paying 15% tax on that $27,500 deductible contribution, which comes to $4,125. So the net tax, the whole situation outside and inside super fund, the net tax you end up paying is $3,275. Compared to the other scenario where you sell those shares to the super fund, of course, you end up paying capital gains outside super fund, which is the same as the previous scenario, 8,500. But because super fund buys off the shares from you, you are not claiming any deductions, which means you don't get any benefit of the tax deductions, which means you end up paying tax of 8,500. And also, of course, the super fund has to pay $100,000 out of which affects the liquidity of the super fund. So the both scenarios are there. It's whatever is applicable to you. But the point is, those ways you can put the money put the shares into the super fund, and you can get the benefit of investing through the self-managed super funds.
Yeah. In summary, there, what it indicates is that if you decide to transfer shares in, there's a small taxation to pay. Transfer as a contribution, that is a small taxation to pay. If you decide to sell some shares, there's a higher taxation to pay, which is the $8,500. But you get cash flow. Personally, you free up from a super fund. One of the things we often hear as an issue that clients have is when they're talking about super fund environment, particularly for slightly younger people, is they say, but retirement age is so far away. I find it difficult as a person to want to put more money into super because 60 or retirement age keeps increasing, 65, 70. That's a long way away from me, and I can't contemplate waiting that long to get my money. I guess what we're saying is if you have an asset like a share portfolio that you've built up outside of super, you can technically get access to your super money by selling those shares into your super fund. The super fund's paying you that cash back, and you can use that money for whatever purpose you need. A question that we've got is just around that $27,500 tax deduction and how it actually works, practically speaking, Nilay. So what does it mean to get a tax deduction for contributing into super in that context, that concessional contribution?
So in a very simple words, there are two types of contributions. One, where you get the deduction. When you make a contribution into super fund, you can get deductions outside super fund, and the other ones which you don't. In this particular case, we observed that 27,500, which is a maximum contributions you can make into super fund, and you can claim deductions outside. Yeah. So that's why we consider 27,500 as a figure. So
and that cap's subject to things like, for instance, the person's got paid employment and they might be getting super from that as well.
That's exactly right. So that made off with the two components. One is the super guarantee contributions, and the other one is your personal concessional contributions. Yes, that's right.
So moving along to the next scenario for SMSF.
So in the previous scenario, like in a situation where we saw that, like we observed that the CBA shares gone up in the value, and that's why there was a capital gains situation were there. Now we are looking at the situation where somebody held shares, but at the moment, the value of the shares has actually gone down from the original purchase. Yeah. And now if we see that situation in these scenarios, how would it work out? So in this particular case, Telstra shares, 10,000 shares held outside super fund. The purchase price was $6.50 in 2015, which is a total purchase price was $65,000. And then the current price is $4 per share. So $40,000 is the value, which means it's kind of 25,000 realized gain if you sell those shares today. Now, 25,000 of capital losses if you sell those shares today. Now, what happens if we transfer those shares to the super fund, or we sell those shares to the super fund? So if we transfer those shares to the super fund, because it's a capital loss situation, you are not paying any tax on it. So there is no tax payable outside super fund. But because it's the same as the last example, 27,500 was claimed as a deductions under the personal situation, and 12,500 was non-deductive contribution. So $9,350 worth of tax deductions obtained outside superfund, and then the superfund ended up paying tax on 15% of 27,500, which is 4,125. So the net tax savings between those two is $5,225. So in that situation, what happens is, if you have any other income outside superfund, you can get the deductions out of it because you end up paying lesser tax of $5,225. Yeah,
because what you're describing, Nilay, is you're almost negatively gearing the share transfer. So because it's in this position where it's a loss, there's no tax to be paid on the actual share transfer itself. So the share transfer is creating a tax deduction for the contribution, which is offset against other income.
True. And also the other benefit is that $25,000 worth of capital loss will be used to offset the future capital loss as well.
That's right. You might own other shares in your own name that you might be able to offset. Yep.
So there is quite a benefit if such strategies can be applied. And in the other situation where they sell shares to the SMSF, of course, there is no gain payable. Of course, there is no tax payable on the capital gains because there is no capital gain. So $0. The only difference is the superfund ends up paying $40,000 cash to the individual person who sold the share. So in that particular case, as you previously mentioned, the person who sold the shares will have $40,000 in cash.
Excellent. So franking credits in an SMSF, why would we want to have these?
Okay, so it's quite interesting because let's see in this situation that if the self-managed superfund has only one investment, which is $10,000 CBA shares, and on a basis of today's valuation, $100 approximately, it's $1 million worth of value there. Now, in 2021, CBA declared this dividend, and this is actual figures that we got it from our clients. Then the actual amount deposited in the bank account was $24,800. And because it was a 100% fully franked dividends, $10,628.57 worth of franking credit attached with that. So the total dividend, the taxable amount, was $25,430 approximately. Now, if we see the situation, if we compare that income in two different situations, one, if the member account is in accumulation account, and one is 100% in pension account, as we can see, the total income was $35,423, and then the super fund 15% tax rate, that the tax amount was $5,314.29. But because of the $10,628.57 worth of franking credits was allowed, so then the net tax refund would be $5,314.29, which is an amazing outcome for the client, because just by owning those shares, they're just getting, even though they end up earning 35 grand worth of income, they're still getting a tax refund of $5,314.
So we mentioned at the start of the webinar this 40% plus benefit, actual income benefit of a franking credit. So the way I'm trying to explain it is that, or for people attending the webinar to think about it, is if your top tax rate's closer to the 48%, you get your benefit by a reduced tax. So you end up paying somewhere lower to sort of 15% tax on that dividend, because you get a credit for that 30%. If your tax rate's 15%, which is the case of a super fund, not only do you reduce your tax, the ATO actually gives you that tax benefit in cash. And this is where franking credits operate different to negative gearing with property, because negative gearing with property is you don't get into a position with property where the government will actually give you the negative gearing benefit in actual cash. That negative gearing benefit has to offset other income. And that's what's very unique about franking credits. You're getting dollars from the tax office.
That's right. And that's a difference. Like if you hold shares outside super funds, and if your marginal tax rate is high, you may not be able to get those tax benefit like as you can get it in super fund. Just because of the total tax rate in the super fund is less. So that's a simple difference between them. Now, if we see the second situation where the member account is 100% pension, the tax situation is even great, because you're not paying even 15% tax on that total income, you can put your hands on 100% of the franking tax credits, which means 10,628. You get the refund of 10,628.57.
So it's fair to say then we end up having a significant number of clients who are in this pension phase with super funds owning ASX listed shares that pay franked dividends, and they're essentially living off the franking credits because they're getting refunds of significant sums of money every year.
That's right. Like I've seen so many of clients of ours who are literally living off the franking credits refunds because they are on a pension phase, so they withdraw just the bare minimum pension they need to withdraw, but because they get significant amount of tax refund, they don't need to withdraw more pension. So that's the benefit of having investment in a listed company who provides significant amount of franking credits.
Thanks, Nilay. So, Nick, we've got circumstances where shares are held for more than 12 months, and a little bit about how that works.
Yeah, just a slide with a few high-level concepts in relation to the capital gains tax discount. So it's often referred to as the 50% general CGT discount, or just the 50% discount. So what happens is it's very straightforward. When you dispose of your shares, you may be able to reduce your capital gain by 50%, which is simply a reduction of half. So the discount is available to individuals, trusts, and self-managed super funds, but it's not available to companies. So if a company holds shares and sells those shares, it can't claim the discount. You have to have owned the share for at least 12 months. So if you buy a share and sell after 6 months, you won't get the 50% discount. So as we said in the first point, individuals and trusts receive a 50% discount, but self-managed super funds only receive a 1/3 discount, or 33 1/3%. And that's because the super fund tax rate is already very generous at 15%, and effectively means that if a super fund holds a share for 12 months or more and sells it, its tax rate will be 10%. Interestingly, if you've accumulated some capital losses, you have to deduct your capital losses against your total gain before you take your 50% reduction. Something that that often confuses people when they're doing the calculation of what their capital gain will be in their head.
We have a really relevant question from a member of the audience. So they've asked, if you have a couple, and this is a very common scenario, you have a couple, one couple's on a higher income, one member of the couple's a higher income, the other member of the couple a lower income. How do you make the decision to buy a growth asset like a share? Because the higher income earner, you might want to buy the share to get negative gearing benefits, but if you sell, that person will have a higher capital gain because they're in a higher tax rate. Or do you put the shares in the lower person's lower person's tax rate's name, to get advantage of the lower capital gains tax in future? And Nick, what sort of happens in your experience in those circumstances?
I generally find that there's no perfect answer. What we will generally suggest is to establish a trust and put the shares into a trust, and that way you have flexibility to distribute the dividends in the most tax advantageous way. You can also then distribute the capital gain when the shares are sold in the most tax advantageous way. Downside is, if you're borrowing, you can't negative gear a investment in a discretionary trust in your own name. So there's no real perfect answer on that one.
I really love this question because it's one which it's one that doesn't have a simple answer to it. It's very circumstantial. One of the things I would say to the person who's asked this question is that if you are making a decision, what you do want to do is think about what is the intention of the purchase, as in, when are you seeking to sell this asset, as in planning with the end in mind. If you're buying a CBA shares, are you planning to sell them in 2 years? Because if you plan to sell them in 2 years, that will be a different answer to one if you're going to sell them in 15 years. My view when it comes to investing, and this is just a personal view, it's not advice, is that the longer the time horizon you have when it comes to investing, you're always going to end up with a better tax outcome and probably better overall investment outcome as well. So if you can think in a really long horizon, what it's probably going to mean is you're going to end up buying those shares most likely in the higher earner's name, because you're not going to have a capital gains tax consequence for a very long time, and you're going to have an ongoing tax benefit, which will be very beneficial. So that would be almost the best way I could describe the answer on that one. Essentially, seek some advice would be the best answer. And then finally, Nick, we have a little bit of a tax planning tip for people who own shares come to 30 June of the year.
Okay, so when you get close to the 30th of June, what you should do is examine your tax position with respect to any capital gains that you may have. So in this example, you own CBA shares and you've sold them and made a profit of $25,000, and you currently own some Cochlear shares and you've got an unrealized loss of $30,000. So what you could do is you could sell those Cochlear shares for, realize your $30,000 loss, and you could offset your $30,000 loss against the $25,000 profit that you made on the CBA shares, effectively meaning that you won't pay any tax on the profit on the CBA shares.
The share market's an interesting one because it provides people with the opportunities that a property market may not. So The two things which distinguish the share market from the property market in this instance are the capacity to buy and sell an asset really quickly. So with shares, you can buy and sell on a market exchange, whereas with property, you've got to go through a listing campaign, you've got to wait for settlement periods, etc. Buying back a property is difficult too, because you have to go through an arduous process to source property and finance. The other thing is cost of transaction. Property has this, the transaction costs associated with agents' fees, getting properties ready for sale, and then rebuying with stamp duties. Those costs are really significant. They could be 5 to 10% of the value of the property just in transaction costs. Share markets have a brokerage fee in and out, which are generally reasonably minimal. So you can do this with minimal costs and create a benefit of wiping out a tax bill.
One thing to add in there is that you do need to be careful to not buy the shares in Cochlear back on the same day, or the ATO may consider it to be what is known as a wash sale and a scheme to minimise your tax. So need to be a little bit careful about that and make the main reason for the transaction something other than on a tax basis.
Yeah, yep, spot on. One bit of advice I'd give the audience is that you'd never undertake a transaction for the sole or dominant purpose. And the definition is a sole or dominant purpose of a tax benefit. The tax benefits are always secondary to a commercial outcome. We're very careful in terms of documenting these things for our clients. So I guess we would recommend that you would have the commercial considerations first and foremost, and the tax considerations are certainly second. Fantastic, guys. Well, thank you for your participation, Nick and Nilay, once again. It's been great to have you along, and thank you, audience, for helping out. We do have a couple more questions, which I'll quickly answer because we've got 1 or 2 minutes to go through. So we've got one question here. If I've only invested shares for a few years, but I've had a net loss position each year, can these losses be only applied to my tax once a net gain position has been declared? Nick?
So the answer to that is that capital losses are carried forward indefinitely until you make a capital gain. And the capital losses can't be claimed against ordinary income. So you do have to wait until you make a capital gain before you can offset the capital loss.
Yeah, but they are indefinite. Excellent. Well, I think that just about wraps it up then, guys. Thank you. Thanks for your participation, Nick and Nilay, and thank you for all your attendees today. We look forward to seeing you again very soon. See you next time.